people have this mistaken belief that there are firms that want to automate everything, right? And just kind of blindly, invest on data, kind of ignore all the qualitative signal and just, have a machine that tells you what to invest in. I am not doing that, and I don't think that venture will ever get there, just because there's so much subjectivity to how to evaluate markets and change and and teams and people.
You're listening to the Sandhill Markets podcast. I'm your host and Sandhill Markets CEO, Adam Hardy. Here at Sandhill, we focus on providing education, community, and access to venture. With this podcast, you'll get a seat at the table for discussions with other founders, investors, and innovators. I'm excited to learn a lot from these discussions, and I hope you are too. All right, we're live. Time to sound smart.
I'll do my best.
Yeah. Well, for everyone who's maybe listening, Ed comes to us through Revere. What's the best way to describe Revere? I guess I'll throw that to you first, from the manager side. Maybe you know a little better than me.
Yeah, that's a good question. I guess there's a few different parts to it. I mean, from what I understand, they're trying to build a lot of sophisticated products and a community around emerging managers. And, my understanding is there's a few different parts to it now. There's one part that's, more specifically LP oriented. So helping, LPs understand the emerging manager landscape better. One of that's through software to better evaluate and analyze their underlying portfolio. And then one part of it is the ratings. So they basically do deep diligence on emerging managers at the level of sophistication that an institutional LP should do. So they'll dive really deep on an investor's track record, their strategy, areas of differentiation, et cetera, and then write reports on those for LPs and for us. So yeah, I've had a really great relationship with them. I think very highly of them. I think they really understand, one, how to evaluate venture firms really well, but then also just, know the emerging manager landscape really well as well.
The interesting word that you share there is should. Diligence they should do, right? I think, and it's that's kind of a little like half joking on my end, but I think the thing where I first met Chris, who's one of the founders and CEOs at Revere, and we've talked for a while, and it immediately made a lot of sense to me because I think that the consolidation aspect, like consolidating that data and doing that kind of third-party review allows for a really good sense of what is good, right? Because how do you know like good from great from bad without kind of context in the market? And I think that it seems like Revere has done a really great job of being able to provide that service and like does something that institutional LP maybe wouldn't be able to do on their own unless you have a huge team behind it, right? And like maybe you should do it, but like you're spread out across maybe a bunch of different assets or whatever. So to have the focus is super cool.
Yeah.
And this is where I'll plug you a little bit and talk you up in terms of how we got introduced, right? So I'd known Chris for a while, wanted to do something, and we were thinking about how to highlight emerging managers and what to do about it. And what we ended up actually deciding on was to go across their rating system. So they have, I think, 5 different rating categories. One of them is sourcing, another one is team and background. I'm forgetting what the other 2 are. Maybe I'll write it in the doc. But sourcing was like another first theme that we decided to touch on. So what this episode and what we'll actually end up getting, I'll kind of drill you on a little bit in a fun way, in a nice way, is their sourcing strategy, which is where, according to Revere's framework and the deep diligence that they do, your top decile or top whatever in there of all of the managers they reviewed, they've ended up kind of assigning and they do like a scoring card basically to say Ed and Alpine, the firm that I'll let you kind of describe a little bit in a second, are top tier. So I'm super interested to kind of go deeper on that. But before we do that, what we'll do is, and I'll pass the mic back to you. Would love to get background, and then we'll get background on you. We'll get background on the fund. I'm sure it'll kind of mold together, but then I'll ask a bunch of questions from there, and then we can get into the sourcing and then other stuff from there.
Yeah, sounds good. So I've spent, the bulk of my 15-year career on the venture side, but I had a startup-related set of roles before that. So, I spent my whole career in Silicon Valley. Went to school at Stanford, studied computer science, got 2 degrees from there, a bachelor's and a master's. So I have a pretty deep technical background. Coming out of school, I worked with startups and inside of a startup as well. I worked in investment banking doing tech M&A for growth stage startups here in Silicon Valley. And then I worked inside of what was an early stage consumer startup in the podcasting space called Stitcher. I headed the business side while I was there, so helped to run finance and a lot of the business functions internally at the company. I joined as employee number 23. We scaled up to about 100 employees or so, and then we sold the business to a big music streaming service. So I left there after a couple of years, and then from that experience, I loved working with startups. Being inside of one, I just love the energy, love the innovation aspect of it. And I loved helping founders too. And, a big part of my role internally there was working directly with the founder CEO to figure out what I could do to help turn that business into a success story. And I wanted to do that in a more scaled out capacity. So saw venture as a way to essentially scale out the founder support stuff that I'd been doing internally at the company. Spoke with a bunch of venture firms, and I really hit it off with a firm called Redpoint. Redpoint is a very established venture fund here in the Valley, been around for about 25 years. A generalist firm, has both an early stage and a growth practice. I joined their early stage team, and I was there from 2013 until 15, so about a decade ago. And I really enjoyed spending time on consumer when I was there. So I love consumer internet and consumer startups. One, because they're everyday companies that my friends and family use and I use, and they're kind of easy to understand and easy to build passion for. They're mass market. And then the last part about consumer that I really like, and this ties to the Alpine strategy that we'll go into, is they're discoverable through data. Meaning consumer companies tend to throw off a lot of data about them, even at an early stage, data on user growth, data on engagement, data on NPS, on customer satisfaction, and things like that. Like they generate buzz and virality. And those are signals you can pick up on if you have a data-driven approach. And so that's another reason why strategically consumer makes a lot of sense for me. So I focused on consumer when I was at Redpoint, was there for a couple of years. And then in 2015, I came across a pretty unique opportunity to help start and scale up a consumer-focused venture fund called Goodwater. Goodwater back then was an emerging manager technically. We were a fund one, starting out with just 2 partners and myself on the investment team, so really small team. Early stage focused. We were, when we started out, US-centric and predominantly doing Series A's in consumer tech companies. Over time, that firm scaled up a lot. So over a 7-year period when I was there, we went from that initial fund to several billion of AUM. They just recently raised $1 billion fund. So, very, very large at this point and multi-stage. And it was a lot of fun helping to, one, spread the firm out in terms of geography. So we did a lot of international investments, started to dabble in Europe, Asia, emerging markets like Latin America and Africa. And then also across stages too. So started to do a lot more growth investing specifically. So I was there for about 7 years. And then in late 21, early 22, I had the itch to start my own fund. And it came about through a bunch of different things. One reason is it's just something I'd been passionate about doing at some point. And it was always a question of when, not if, I wanted to start my own thing. I also just really wanted to refocus on doing exclusively early stage investing, particularly at seed, really, really early companies. And, a lot of incumbent firms at the time, including my own, were shifting to be more multi-stage, do a lot more growth, more later stage investments. And I just wanted to really refocus on early stage. So decided to spin out and launch my own fund. And so started Alpine officially in 2022 and been, slowly investing since late 22. Made 6 investments so far and looking to do a whole bunch more. The quick kind of highlight summary of the firm is it's a predominantly seed stage fund. The way I describe the stage that I like to invest is the first post-product round of a company. So right after a company has launched a product, the team is still really early. It might just be a handful of founders or a few core engineers. The business model is still going to be really early. Some of my companies are pre-revenue, and so very, very early traction. But there's some early signs that there's product market fit. There's some signs around engagement, around growth, around virality. Like the product is starting to work, but it's not yet obvious to the market. And it's not yet this kind of obvious hockey stick. So that's typically when I come in and invest. I sometimes lead rounds or co-lead rounds. So I'm comfortable issuing a term sheet and being the investor of record in a round, but also have the flexibility to not lead and to just participate alongside another lead or alongside a syndicate of other firms as well. So it's a pretty flexible mandate. And I predominantly focus on consumer and prosumer companies. So companies that have bottoms-up adoption and PLG-driven growth, so product-led growth. And that's sort of my sweet spot. The unique thing about my fund that is quite different from a strategy perspective is I have a very heavy data-oriented approach to how I find and evaluate companies. So this is in contrast to a lot of other venture firms that are more network-centric. So the industry as a whole is historically venture capital has been an extremely network-centric, network-heavy industry, right? Even to this day, almost every firm distinguishes itself or tries to distinguish itself based on their network of founders that they have access to, right? And it could be specific around a company, right? Alums of a certain company, and maybe the partners of that firm are alums of the same company. It could be Stripe, Uber, et cetera. It could be a network around a specific domain, like a specific part of deep tech or biotech, and they know all the researchers in that particular field. It could be something geographic, right? Like you know all of the exceptional founders and executives and angel investors in Seattle, as an example, right? And there are firms that do that. And so that's one flavor of specialization that has been popular, and there are a bunch of firms doing that. My area of specialization is a little bit different in that it's not so much specific around a locus, like a network approach, but around the fact that I can build systems that are able to identify companies that have some kind of traction or some kind of performance, but are otherwise undiscovered. And so, I'm not dependent on referrals for deal flow. Like I don't have to wait and hope that someone I know sends me a founder that happens to be raising and they happen to think of me. That's not the approach. It's a much more proactive, outbound heavy approach in trying to find companies that maybe I haven't heard of, that other people haven't heard of. The founders might be really under the radar, not that pedigreed, but the underlying products themselves are somehow doing well. They're getting users, they're getting traction, they're getting adoption. It's not yet at immense scale and obvious to everybody, but it's starting to happen. And so that's what I try to pick up on. And I've built a series of data systems that are able to pick up on those signals.
There's a ton I'm excited to get into. The place I want to start before we go into, because I have questions about data sources, tools, like all. I think it's an exciting, and I'm one thing I really want to focus on too is I think one of the things you said about network driven, and how that can kind of only get you so far. I think, right? Like I think like getting hired at a fund, having a great network is, I think, that's maybe a solid pitching point. Like, I know everyone in AI, and the fund is like, okay, maybe you're the right person to become a partner or like a principal or whatever. But that's very different from starting your own fund, because and I think that this is something that I've talked to a lot of emerging managers about. That network doesn't just spit out unicorns constantly, right? Like you have to deploy the fund over a long period of time, and your friend group or like your peers, unless you have a systematic way of bringing new people into the fold, a systematic way of kind of reviewing new companies. So anyways, super excited to get into that. Before we do though, I want to stay on the kind of backstory a little bit.
Sure.
Because when I think of a Redpoint, and there's a quote, and I'm forgetting one of the founding partners at Redpoint,
Yeah, there were a few. Jeff Yang is
Yeah,
the
Jeff
most
Yang.
prominent
Sorry,
one. Yeah. Mhm.
Jeff Yang. Jeff Yang had, and Redpoint I think has very much progressed in a lot of ways. Like they have like some great
Yep.
content, and they've
Yep.
modernized in some ways. But Jeff Yang had a great quote when COVID was starting, where he said, like, I don't like to write a term sheet unless I've had a bottle of wine with the founder. And it
Yep.
was during the discussion of like Zoom calls and whether or not, and it struck me as very old school network driven, and maybe I don't think that's necessarily what Redpoint is, but they can be because they're so like established and it's a brand. And so I'd love where then Goodwater I do know is much more data driven as well, and then you kind of went the data driven route. So can you talk a little bit about your experience across what I would describe, like, let's put Redpoint in, this is maybe unfair, but maybe let's put Redpoint in that like classic network approach, and maybe put Goodwater in that, in this kind of newer data approach, and how you, when you look back on that experience, obviously you went a specific way and that kind of speaks for itself, but what do you feel like are some of the pros and cons? Do you think like, oh, everyone's going to go data eventually, or do you think there's some parts of the network that
Mhm.
still win? Like, can you kind of go deeper
Yeah.
on that for us?
Yeah, totally. I think there's a lot of nuance there. So I don't think it's as simple as, and it's a little unfair to Redpoint to kind of bucket them as, maybe not as forward leaning on certain things. For what it's worth, I do think very highly of the firm, and they've evolved a lot, and
Right,
are very actually forward leaning in a lot of ways,
for sure.
including some of the data stuff. They gave me the leeway to experiment with some of that internally there. So I think they're pretty good at it. I'd say so. One thing I want to highlight is I think there's a bunch of stuff around data-driven investing that is that's misunderstood. So, one thing, for example, is I think there's this false comparison that's made with quant hedge funds, where you look at quant trading in
Mhm.
other asset classes like public equities and and more liquid markets, and people have this mistaken belief that there are firms that want to automate everything, right? And just kind of blindly, invest on data, kind of ignore all the qualitative signal, and just, have a machine that tells you what to invest in. I am not doing that, and I don't think that venture will ever get there, just because there's so much subjectivity to how to evaluate markets and change, and and teams and people. So my process actually tries to blend the two, and kind of harmonize them a bit. Where I use the data much more is actually not so much on diligence, like trying to, score a founder, or use numbers to try to, score an investment per se, but it's more around discovery and the sourcing part of it. So, where I think data can be really helpful is in helping point you to companies that you don't even know exist, right? But they are out there, and there's something that a machine can pick up on because it has a more exhaustive capability to search, everything, and highlight things you might have overlooked, right? Like, oh, I wouldn't have maybe thought that this company was that interesting because the founder doesn't have a particularly impressive background, and it's not really that sexy looking of a product. But there's some metric where it's really outperforming, and if you dig in a few layers, you can see it. But a machine's able to pick up on that, or a model's able to pick up on that much more quickly. So I think data is really helpful in leveraging data can be really helpful in uncovering patterns that you might have overlooked, or just discovering new things. But I try not to go too overboard and allow data to dictate an investment decision. So much like the analogy you were saying, I do try to do the analogy of opening up bottle of wine with a founder, right? I do
Yeah,
spend a
yeah,
lot of time with them, right? I try
yeah.
to figure out how they are as people, how they execute, how they hire, what their ethics are. And it typically is over like in-person meetings and a meal where I'm either going there or they're coming here, or maybe they're local. So I think there's a lot of value to that approach, the more artisanal approach to venture. But I think data is really helpful in expanding the reach of it, if that makes sense, right? So you're not only looking at founders that are 1 degree away from you, and it's a very small, narrow set of people, but you can expand your search set almost in a way to be, near infinite, right? And look at a broad array of founders. So that's kind of how I try to approach it.
No, that makes a lot of sense. And I think that the word artisanal came up in a podcast I was listening to recently with Eric Tornberg, and I'll plug them because they do a great job. But Eric Tornberg and Sam Lessin were talking about it. And Sam's been making kind of a push for a return to the artisanal approach. And it's interesting in the context of the data, because sometimes I think when you hear the data driven, it does think about scale. And Goodwater has kind of scaled up in some ways, and maybe using data to scale out decision-making processes, to scale out sourcing processes, obviously. But that approach of keeping your personal network out of your looking around, kind of because of how just as a human, you're so, we just live in bubbles, there's no way around it, is super interesting. And then almost kind of turning off the data engine a little bit once you get into there's something interesting here, and now let's be seed investors, right? And now let's be that person to person. Do I think that you're going to make it? From that very qualitative perspective. A question that comes up is, did you find yourself drawn to consumer because of the data, or were you drawn to consumer and then you was it which came first? The consumer, love for the data, or the love for the consumer? I guess maybe you could say both.
Yeah, it's a really good question. I actually think about that a lot. I don't remember, to be totally honest. I think it just kind of melded together. Look, I had consumer experience before going into venture, right? I worked at a consumer company, so at a consumer startup. So I felt more comfortable with consumer. Maybe that's one way to put it, rather than, and I felt, and to be honest, consumer companies are also just a little bit easier to understand, right? From a business model and framework perspective, they're a little bit simpler. Not that they're easy to invest in, but they're just easier to understand conceptually. Versus, with enterprise software, I felt like there was a much steeper learning curve, and it was I just found it a little more boring. So I think, naturally I felt a stronger affinity to consumer. But then it really was amplified by the fact that I realized, consumer companies have a lot more signal. And so, I can use data to find consumer companies in a way that it's harder to do in other spaces. So it kind of aligned, really nicely there.
Yeah, it's funny because it's the space that has the public data, and maybe that's a good kind of segue and to get into kind of what your actual stack looks like. So what are you, as much as you're willing to share, and maybe there's some proprietary aspect to it or whatever, but when you're actually pulling that data, right? I'm guessing it's not you're not looking at Google Trends. I'm guessing maybe that's a part of it, but
it's part of it. But
yeah. So walk us through a little bit, some of your most used tools, favorite tools. What is off the shelf? What's custom? As much as you can get into it.
Yeah, totally. Yeah, so there's a few different kind of parts to it, and again, I can't go too much into a lot of detail, but at a high level, kind of the way the system is set up is, at the base level there are raw data sources, and typically a data source is it either comes from a third party vendor that's aggregated it somehow, and it's like semi-proprietary, but you can pay for access to it via an API. And these are typically tied to a specific platform, right? So, for example, on the mobile side, there are mobile app data vendors that, try to track app analytics. So they'll, have a bunch of different metrics around apps. So, download volume, reviews, ratings, active users, retention, anything kind of related to mobile app for iOS and Android. And, and then there are all kinds of different cuts you can do around that, by country, by category, and all kinds of things, and demographics. So and then there's corresponding stuff around web and social. So there are a lot of these third-party data vendors, and then there are a bunch of things that you can kind of scrape on the open web as well around companies that are publicly available, or you can sort of quantify them on your own. So, you can do things like, tracking community mentions, like on Reddit and Discord and things like that, right? So how much, kind of word of mouth or buzz a particular product is getting. Google Trends is, part of that as, one kind of specific thing. But, point being, there's a composite of a lot of different raw data sources. And, the framework there's some kind of time series that you can quantify around a company's traction, right? And that traction could be growth, it could be engagement, it could be satisfaction, a bunch of different things. But essentially, there's some kind of log of a some way you can quantify a company's trajectory, right? So there's that. I have a bunch of data crawlers that aggregate all kinds of different data sources there. Some of which I pay for, and a big part of my budget goes towards that. Some of which kind of I crawl on my own with different systems. And then from there, one of the biggest challenges once you have a lot of this raw data is understanding your investable universe. So this is the challenge that a lot of firms actually don't fully appreciate until they start to try to do this themselves. So unlike on the public side, with hedge funds, if you're doing, let's say, public investing at a hedge fund, your investable universe is very well known, right? Like if you're investing in US public stocks, you can go to any database and see all the, I don't know what the number is, a few thousand or so, right? Public companies. It's very well understood. It's very well known. Anybody can get that. With startups, just because there's so much that's hidden and in stealth, and and there aren't really published databases, and then there are also so many companies being formed all the time. There's no definitive way to know what are all the early stage startups out there. And so this is one of the biggest kind of issues with sourcing, is just knowing what's out there when so much is invisible. And so a big part of my effort is building a composite of both tracking known databases, so things like Crunchbase and PitchBook and known startup databases, but also doing a lot of work on my own to figure out, okay, are there raw products that look like they have some momentum and are venture backable in the sense that they're an early stage startup, maybe they're bootstrapped, maybe they raised a little bit of money, but can I get that information, right? Or scrape that information somehow? And so, I built up a universe of, at this point, about 50,000, what I consider to be investable seed stage startups globally. And I think my particular interpretation of that in my database is pretty proprietary. Like it's very unique to, the way that I evaluate the world of startups out there. I don't think anyone else has replicated this exact set of companies. So that's a pretty unique thing just to start from, right? So knowing that investable universe. And then once you have that, then you can layer on, all the analytics and metrics you have for each of those companies, and then do some data modeling on top of that to figure out, okay, within this huge universe, what are the top companies that have, some superlative metric or some kind of signal and otherwise a lot of noise.
And two questions that come out of that for me are, one is how much is like benchmarking in comparison a part of that, right? Because it's if everyone's doing well, then no one's like, because it's about finding the ones that are standing out. So are you comparing, growth across, or is it sometimes just kind of clearly a standout? What does it end up looking like in practice? Like, are you splitting hairs on things, or is it pretty, when it shows itself, does it show itself relatively like clearly?
Yeah, it typically shows itself pretty clearly. And it depends kind of what you're looking at. So if it's more growth related, like just raw, user growth, revenue
something
growth,
happens. Like there's an inflection point in the graph, and it's pretty clear that something's happening here, and it's time to look into it.
Yeah. Or it's been consistently doing it for a while. Like maybe it's a bootstrap company that is. I see this a lot with more international companies. So like Eastern Europe has a lot of these bootstrap agencies. It's like 3-person teams that build some prosumer thing, and then it just slowly kind of ticks up, but very steadily. But typically when something inflects, it kind of stands out. So it's not splitting hairs where it's like you'd be surprised that most, at least early stage startups, don't perform very well. Like,
I'm not surprised. Having been an early stage founder, I'm very aware.
Yeah, I'm sure you're aware of it. Like most are kind of like, it's sad to see, but like if you just kind of interpret it as a graph, most are flat, right? Yeah. Or just not doing anything, right? Most are they just have no metrics, right? Like no growth, nothing really observable. And then once in a while, you see something that starts to pop, right? And it could be a big spike. It could be kind of slowly starting to get there. But those are things I typically will look out for, are these like pops. when that happens, it usually stands out. The issue, though, is kind of the opposite problem, which is a lot of them are false positives, right? So it's very important to understand why something pops. A lot of times it's something exogenous, like a PR hit, right? Like, oh, did this happen to have an article that got written about them, or they were featured in some list somewhere.
Yeah, some viral whatever.
Yeah, or like something, or like they did a TikTok video that went viral, but
Yeah.
it's
And
like
then
a
all of a
one-time
sudden,
thing.
the grass a hockey stick, but
Yeah, it's clearly hockey stick, but
yeah.
like a lot of those, fall down right away, right? So, so I'm constantly kind of scanning. There's always false positives. So, every day I see a lot of these kind of, not a lot, but there are a good number of these, these spikes that will quickly die down. And so I'm just trying to figure out, what's going to sustain. And, so I'd spend a lot of time kind of studying these pops and understanding why, and, is there something that's actually starting to happen? And, and get to that answer pretty quickly, because, once something's been popping for like a reasonable amount of time, it does start to get more known, right, out there. You can't just study these infinitely, right? So there's kind of a speed, aspect.
That's a good line. Once you've been popping for a while, then it's like it needs to be an ing verb. It can't just be a one-time pop. It's
yeah, totally. So
that's super interesting. And so the false positive takeaway I think is interesting. And then as a that data-driven fund, is the data being used in a way to almost to get there first, right? Because if they're going to continue, right, like if they were going to continue to pop, right, it's like they're just clearly like compounding in one way or the other, and you're seeing the data. If you didn't, let's say you didn't reach out, nothing happened, the idea is that they would eventually probably become more well-known. Like if the thesis were to continue and they were actually to kind of continue on that trajectory, but the data allows you to see it before everybody else. Is that how you think of it? Is it where, like, do you think people just would never see it, or is it that you see it before other people do because your instrumentation is much more sensitive to it happening compared to like a year later when everyone's like, oh wow, everyone talks about this company all the time, and you're like, yeah, well, that's you're just seeing that, like, the wave crest, like it's been building for a long time.
Yeah, I say there are two profiles of companies I back, and that is one of them. So there's, I'd say one profile is a company that just pops and starts to become a rocket ship, and I'm able to find it first, right? Because exactly like you're saying, my data platform is much more sensitive to it. Most people are not really tracking these companies this early. A lot of the other data-driven firms are generally more later stage, where there's just
more data. There's more data in the later.
More data, more longitudinal kind of traction. So I'm really trying to pick up on these really quick inflections. There's definitely a speed element to that class of company, but there's actually another kind of company that I like to back as well, which is where it's not so much growth is the primary metric, but there's something deeper on engagement where it's more that the company's overlooked than it is undiscovered, if that makes sense. Meaning, it might still not be popular for a year or two, even if it's compounding. And it could be that the sector is really out of favor. It could be the business model is really out of favor. But there something kind of causes the market to overlook it for a really long time until it compounds enough to be at enough scale. A good historical example of this at my prior firm is a company called Monzo. So Monzo is one of the leading consumer fintech companies in the world. It's the biggest neobank in the UK. They just raised another round at, I think, like a $5 billion valuation or something. It's profitable, poised to go public. When I was at my prior firm, we led a relatively early round into the company. And the first few rounds were like not very popular. And even, until I would say relatively recently, there were a couple rounds that we did in the middle that also were really hard to get done. This is a company that was misunderstood for a long time because they had really great traction, but and it was pretty well known because it was one of the most popular.
Yeah, they've been around for
they've been around for a while. But even when it was kind of at scale and everyone in the UK knew about it, a lot of people overlooked it because mainly because they didn't have a great business model until very, very late in the company's trajectory. So it was a free product. They had a lot of different costs, support costs, infrastructure costs, and it was like gross margin negative for a really long time, which turned off a lot of investors.
Yeah, I've
And
heard that.
a bunch of other things, that
Yeah.
had a lot of hair on it. But point being, the thing that I think a lot of people overlooked, but where I put a lot of emphasis was on their retention and engagement. So this is a product that had incredible stickiness. Something like 60% of all of their users they ever got were weekly active, which is like an absurd ratio.
Yeah. Yeah.
80% were monthly active. It was like Instagram type of usage, right, for a fintech product, which is
Yeah. Yeah.
unheard
Yeah.
of.
Yeah.
And they had a great community. So there were a lot of these like more consumery, aspects of the business that I really appreciated. And eventually the market got there, but it took a long time. And so this is, contrasting example of a company where it's not necessarily that, I was first to see it or hear about it. It had actually been a pretty, known name, but most people didn't want to back it because there was a lot of hair on it from a financial perspective. But, there are other metrics that were overlooked.
Would you, yeah, so kind of regurgitating to summarize that there's that when you look at the data, there's the classic like growth inflection point where this is headed somewhere and maybe it's compounding and it's going to be a big company on that kind of rocket ship model. But then the other one where maybe underneath just pure growth, where there's specific metrics that are really kind of going to draw your eye to it and make you say, maybe this is something, the overlooked nature of it. So early on the rocket ship kind of ride, but then also like trusting, going a layer or two down in the data to understand if the company has something special kind of under the surface. Would be the two kind of benefits of
Yeah, that's right.
Have you met Zach Hargett? You know Zach?
I've heard the name, but I don't think I know him well.
We had a conversation, maybe a couple of weeks ago, and he talked about kind of this niche consumer behavior model and how he was early at Loom.
Okay.
And he was very interested in and talked about uncovering early behaviors, and right when you see things that are really popular in a really small group of people, and he does it more in like a, I think, less data driven way. But it reminded me of this, right? Where you're looking for upticks in relative, or it could be a small community that really like loves something, or that is just like addicted or all in on like a specific small product, where it wouldn't show up in the broader world. Yeah. But from the data perspective, and I picture you, huddled over one of those the earthquake ticker, right, where you've got like a very finely tuned earthquake machine.
Yeah.
No, very, very cool though. And I think that when you, and this is something that, and I would love to get some stories kind of from the process, because the outbound approach I think is so exciting, right? Like the network and the old school, and the ugliest thing to say about the old school kind of VC approach is, know a guy who knows a guy, and yeah, my buddy went to this school with him and I think he's great, and like, let's throw a couple $1 million at him and he'll figure it out. And it's like, and whatever, that's again the ugliest way to describe it. But compared to the outbound model of saying to a founder and reaching out, and I've had this experience myself a couple times where that's so exciting, where why you like it.
Yeah.
Right? And you're reaching out to a founder saying, I like it for these reasons, and they're immediately like, oh my God, thank you. Like, that's so great that you actually, maybe you've noticed us or thought about it. But I'm wondering, in your experience, what is not the close rate necessarily, but like, what is the typical reaction? Are people surprised? Is it always a venture business? Like, do you control for that before the outreach? Is it sometimes, I'm imagining a bootstrap business that's kind of going well? Like, give me some storylines or from what's typical, maybe what's surprising from those sort of, that outbound process.
Yeah. Yeah. So I meet all kinds of founders, and with different perspectives on venture. I'd say, and I think this goes to what you were saying around, the founder VC experience historically has been really bad for the founder, right? Like, if you think about it from their perspective, they're used to meeting a VC. the VC is probably is overbooked. They're going to be late to the meeting. They haven't done any homework. Like they don't know who they're meeting, and it's just a bad meeting, right? And I've seen this from both sides where it's clear that they haven't prepared. It's clear that it's just thrown on their calendar because somebody referred it, and their EA just like put it down. And as a founder, you're just answering dumb questions, and it's clear that they have no interest, or they're not prepared, and it's just a bad conversation. Contrast that with I'm very deliberate about when I reach out to founders. I actually don't take a lot of first meetings because I do so much pre-screening with the data stuff. So typically I'm only meeting a company if I have a high degree of interest already. And I've done a lot of prep work. I've studied the product. I've studied the founder, and kind of know a lot about them ahead of time. And it really shows both in the outreach when I reach out to them, but then also in the first meeting itself when one, I can just skip ahead straight to more in-depth questions, go really really deep with them, but also just like I think the enthusiasm that one has when you're actually interested in the company, and you can explain why and why you're passionate about it. It goes a long way, and it really works well. So I haven't typically found any issue getting in front of a founder, even if they're not raising, even if they never want to raise money. They're typically open to taking a meeting just to hear my perspective and get feedback. And it's kind of like being a fan, right? Like everybody wants to be a fan.
Yeah. You're a fan before. You wouldn't reach out if you weren't a fan.
Yeah.
Very different from the old school. Like I picture, almost like a loan clerk at a bank is like the old school VC where you're going to walk in, it's going to be a big fancy building. You're going to be like, hey, like, can I borrow a second of your time? He's like, yeah. Let's get it over with. Compared to, oh my God, I love your stuff. Like, can we connect? Like, it's like the totally opposite.
Yeah, it is. And so, that's my approach, is really to come at it as like, I'm a fan first. Like I'm a fan of the product. And so want to like, let's talk about that. Right. And if it so happens you're open to fundraising, we'll have that discussion too. Yeah. And so, typically on the fundraising side, it goes one of, many different ways. There are some companies that like, they just never want to raise money, right? And they never need to. They're bootstrapped. They're happy being bootstrapped, and that's totally fine. There are some that are not ready yet to raise money, but in that case, I'll have met them long beforehand, and we'll try to build a relationship and keep it going in advance of that. And so, sometimes I've intercepted a company a year before they raised their seed round. And this actually one in my portfolio, that's a specific example where I first met him literally a year before I ended up investing. But over the course of that year, tracked it more closely, kept in touch, and then finally we were both kind of ready to do it. And then there are some that, where the timing is kind of fortuitous, where they're like, oh, I was just thinking about, fundraising, or.
Well, yeah, that's perfect. Yeah, well, you just grew a lot, so I bet.
Yeah, or maybe that, the interest there does catalyze that. That happened too. And then they're like, oh, you know what, now that you reached out, maybe I am ready to start that. But either way, I'd say it, and I can't put exact percentages on it. I don't know off the top of my head. I think generally most founders are willing to raise money, especially in this market, if you can come to good terms and and run a good process and tight process. So yeah, from that perspective, it's worked out really well. I can get in front of most of the founders I reach out to, and then depending on their willingness to fundraise, we can usually explore a few different options and go from there.
I'd love to break down kind of those responses, right, of the bootstrap company and the willingness to raise, and because I feel like, and maybe it's just again the the bubble, the VC bubble I live in, but it seems that VC is, I mean, it's still cool, like I said, but it's not as cool, right? There was a period of time where it was like, if you didn't raise VC, you're not doing anything, right? Where now, being a bootstrap founder is definitely a little bit more in vogue than it was.
Yeah.
Have you felt that in your outreach? Yeah, that even just
I felt it. Yeah. I'd almost say the inverse has happened. Where like not taking VC money and being profitable is kind of sexy now. It's in vogue. Yeah. And people brag about it, and like, especially with and that intersects with the AI stuff too, right? Oh, I can be so efficient, and like I never have to raise.
$1 billion company,
and like people aspire to be that. So so I was in my last LP letter, I actually mentioned this very distinctly, where the challenge now is actually not so much in winning. Like everybody, every VC obsesses over winning, right? Like, oh, am I going to get in the deal? Am I going to, get allocation? Is it too competitive? But with this market environment, actually, I mean, deals are still competitive. Don't get me wrong, but that's not the main thing I worry about. It's a second order thing, which is, does founder need money at all, and do they want to raise at all, right? Because they don't. A lot of times they don't have to, and businesses are now being built in such an efficient way where they literally don't have to raise venture money, and they might not need to, and it might not help them. And so there's a generation of founders. Not I wouldn't say it's the majority by any means. It's still a minority, but there are a good chunk of founders now that are building companies that start to inflect, and they're like, I actually don't want or need to, raise a round. I'd rather just, get this profitable, reinvest the profits, kind of build it the old school way. And I'm seeing a lot more of those now versus, a year or two ago, it was unheard of to even think about that. So there's definitely a shift there.
As a emerging manager and someone building a fund, and I would expect, and maybe you can touch on that a little bit, your vision of Alpine in the future, where do you see yourself? Because I feel like the classic model would be to, if you're thinking about growing AUM and maybe, that's maybe the Goodwater kind of model, or, a Red Point, or, the classic successful fund one, grow to a successful fund two, and then maybe decide if you want to just stay, do the USV, like Union Square Ventures, you're just going to stay small, you're going to tap out at 250 and we're good at what we do. Or if you're going to go multi-stage and grow, get into the billions, that sort of approach. But in this conversation of, and maybe it's a little bit like it's too soon to say realistically, if VC will remain uncool, if Bootstrap will come back, whatever. But in a world where the trend continues towards maybe people don't want as much VC, the common kind of storyline that I've heard is that those middle growth rounds, right, your Series A, your Series B, kind of go away a little bit. Like it seems like seed still is seed, right? Where it's you want to make your, that artisanal early stage, founder relationship driven investments.
Yeah.
But it seems to pose a question in terms of what a future of a fund looks like, right?
Yeah.
And what like and reserve capital, and how much are you thinking about following on with all that stuff? How do you think about it as an emerging manager who, from all things that I've heard and I think from the conversation, like is doing well, and hopefully we'll have, a chance at, I would assume you're thinking about, the future. Where do you line up in all of it?
Yeah. Yeah, totally. And I've been asked this a lot and thought a lot about this. So I am not an empire builder, and I don't aspire to be multi-stage for the sake of being multi-stage. On one hand, and happy to go into more detail on this if this is helpful, but I actually think that data-driven stuff is less impactful at later stages. Even though there's more data, I think it's harder to have alpha because it's sourcing is not as it's hard to differentiate on that.
Right?
Yeah, like the universe is known exactly. So I think it's much like we're seeing on the public side, it's it's harder for alt data to be really effective there. So I want to stay really involved at early stage. I also just love working with founders that are earlier, where I can have more of an impact on the company, and over time, my team can do that. And so I want to stay pretty involved there. I do think there are opportunities to scale within early stage. So, geographically, for example, it's possible, this could be a global strategy over time, right? Because the data stuff is, it's country agnostic, right? Data is data. And you have to do some adjustments for each, market, but you largely have access to the same set of data sources. And it has global coverage. So that's, one example. There obviously, more you can do from like a reserve and follow-on perspective, like you said. I don't know if I would go so far as to say the Series A and B rounds are going to go away or be compressed. I think there's still going to be a place for startups that want to, kind of scale the old-fashioned way, or can put capital to use, right, in a more effective way. Maybe
if you could, the argument being like, but if you can take $1 and turn it into $2, why don't you take in
exactly, take more dollars,
right? Take more dollars. Like if there's no limit, if there's not a ceiling on the lot, like why would you wait to invest profits?
So there's some arguments for that. So I could see that happening, but what I would say, and I'm pretty adamant about this, is that I don't aspire to be kind of like a huge behemoth that is investing, mostly into growth and raising ginormous funds, mainly for later stage. I think I think that model is going to continue to be really challenging going forward, actually. Yeah.
Yeah, no, and in terms of my own investing and the kind of the way that the lens that I see on it is I end up with this kind of bookend interest of, like, similar to you, very, very interested in that pre-seed, seed, like very founder-driven decisions. I don't, have my own fund or invest professionally necessarily. So it's in terms of like, fund strategy, things like that. So I'm able to be a little bit more opportunistic of like meeting a founder that I just happen to really be like, this guy's great or this girl's great, and it's going to be something to be excited about. And that personal connection is really the exciting part, I think, of being a seed founder, right? Seed stage investor.
Yeah.
Where you get to be, they're not cool yet, right? They're not big. They're not,
exactly.
Like they're really not in yet. Like they're still, making it. And then the very opposite side that we end up seeing a decent amount at Sandhill, which is interesting, is late stage, like pre-IPO is the kind of the term. But I don't really like saying that necessarily because I think it's misleading in terms of the timeline that IPO.
Yeah, it might be a while.
Yeah, it's still going to be a while. But like, liquidity focused, right? Where it's a multi-billion-dollar company and there's people who did it, right? The trade worked. I want to cash out. Like, how do we, someone wants to buy in because they think that there's more. And that world is just, it's really interesting and it's very new. I in some ways I feel like kind of artisanal seed stage investing, I agree with you, is, I think, and I've thought about this a lot as well, going to continue to be around. Very, like, I think your data approach is super interesting from a source perspective. And then actually with once it's in the portfolio, it's very person to person founder support.
Yeah.
And then the late stage, and that's been around for a while and continue to be around. The late stage seems to have this rise of fall of like, wait, companies aren't going public. So let's, what do we do? Like, this company's a multi-billion-dollar company. How do we put the money to work?
Right.
Yeah. So I'm interested to see, and I'm interested really mostly to see how the trend of, do the best founders in the world want venture money? Do they, and need, or, want and need being, in a gray area word usage wise, but like, I'm super interested to see how the trend goes. Cause I don't know, maybe there's some aftershock, I think, also from a period of, it seems like the pendulum kind of swung way back where it's like, oh, it's the coolest thing in the world, to like, no, bootstrapping, and like the real answer is in the middle, but I'm not sure.
Yeah, I think that's right. And to be honest, I think it's still kind of a minority of companies. I wouldn't say like, 90% of the founders I meet are like, I don't want to raise any money. So I don't, I don't think it's going to be the overwhelming majority, but it is interesting that there is definitely a contingent, that thinks like that. And it's a kind of a new thing.
Yeah. Well, cool, man. I really, really enjoyed it. And again, this has been awesome. And I'm excited to pull clips and get it out there and stuff. And we'll share it with you and get it out to the Sandhill audience. It's been, I love these podcasts because I get to like, learn so much about, smart people doing interesting things. So thank you so much for joining, Ed.
Yeah, sounds good. Thanks for having me on.
Thank you for listening to the Sandhill Markets podcast. If you enjoyed this discussion, make sure to click the link in the description to subscribe to our newsletter. You'll be kept up to date on venture news and our weekly live events where we host similar discussions with other amazing guests. You can also follow us on LinkedIn and Twitter, where we post regularly about upcoming events. Once again, thank you for listening, and talk soon.